Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jeff Kilburg, Chief Investment Officer and Portfolio Manager at Sanctuary Wealth. Jeff, it's great to see you as always. Welcome back to Trade Talks. And this market is continuing to struggle to string together a few green days here.
Yeah, it seems like it struggles to string together a couple hours, Jill, but nonetheless, I remain cautiously optimistic. But today was a big day. It's a jobs report. We had a better than expectations with 390,000. But I think we have to understand, we didn't have 790,000. We didn't have 890,000. We just had 390,000, which was a beat of the expectation. Therefore, we are seeing markets fall on the side that the Fed has the ability to continue with their hawkish approach. 50 basis points at their next Fed meeting. But it's really interesting, and you brought up a great point, Jill, that we've seen this kind of bipolar approach to markets. Everything's gonna be okay, everything's not gonna be okay. We're gonna be in a recession, we're not gonna be in a recession. Let's just go back to the last time I was on, when we had option expiration for the S&P 500. We really saw that influence of that option expiration pin the market lower. We're 8 to 10% higher. And we talked about that day, that resistance in the S&P 500 at 4170. That was the old support level, which is now new resistance. Sure enough, after options expiration, the market went directly there. So I think it's a really interesting moment in time to understand what your exposure is, what your sector exposure, how to potentially tax loss harvest. And this struggle between value and growth is persisting. But I really think the fact of the matter is that we have to understand, bigger term, this is a process. This is a recalibration. This is rates normalizing. It doesn't feel great.
Yeah, and you know, to your point, this almost feels like the market prior to the pandemic, where good news was bad news for the market and vice versa. It's almost like if we were to get a recession, you could actually see that, you know, the market skyrocket from here, because that signals the Fed might dial back a bit. It's very counterintuitive at times, but you know, we're dealing with interest rates, inflation, supply chain issues. Any one of these is a big moment in time, and we just have this confluence of them all occurring at once.
You're absolutely right. And look at China just kind of coming back online outside of their lockdowns this week. Look at PGJ. That's the Invesco Nasdaq Golden Dragon Index we like to kind of track for sentiment. But now that we are seeing mainland China, specifically Shanghai, coming back, will we see demand? Certainly we know there's demand in oil, but I think this is a piece of the puzzle where you're absolutely right, Joe. We are seeing the Fed kind of day trade the economy. And the fact that they're day trading, we are being reactionary. We saw rates move higher. So the 10-year note, what happened in the last 2 weeks? We saw the 10-year note go back under 2.75. That allowed equities to heal, to mend a bit. So here we are with the 10-year note back up near 3%, trading 2.968 due to the fact that we think with this jobs report, which wasn't an excessively awesome jobs report, it was a better than expected at 390,000 jobs report, but the market is anticipating that the Fed will remain hawkish. They can do 50 basis points at this meeting, potentially next meeting. I don't think the Fed is going to do 50 basis points at the subsequent meeting. I think they'll do 50 basis points in June and take a breather and understand where the growth is, what earnings season looks like. There's a lot for them to take in, despite the fact they say their dual mandate is only focused on inflation and jobs.
Right. And you made a great point before that the lines are really blurred between what is growth and value at this point. We needed the valuation reset. There is no denying that. When do you start to get interested in some of these names that have taken a hit, not necessarily because of the underlying fundamentals of the company, but they're just trading in sympathy with either the rest of their sector or with the market overall?
Yeah, let's look at biotech, for example. Biotech has been thrown away. So there are certainly some names that we want to look inside of biotech. But I think bigger picture, those FANG stocks, we have seen a repricing, a price discovery, if you will, Jill. And I think it makes sense to own those names. But we own them, as you know, in a more prudent manner. We like to own them in an equal weighted manner. And that's been the big difference in 2022. How you own the market. Is it market cap weighted like the S&P 500 index? Or is it equal weighted? And I think that makes a ton of sense, because you still want to own these names. And a lot of these names are really on sale. And some of these names that we want to have in our exposure, but you have to think long term. And remember, Jill, last thing, we're in a midterm election year. We talked about this when we kicked off the year. We were going to be fraught with volatility. And sure enough, we have a ton of volatility. I think markets will continue to chop this summer, but we are going to have some certainty. We will see the market move higher going in the fall. So I remain cautiously optimistic.
All right, Jeff, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.